Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. On the show today, Martin Cobb is our guest co-host. He is the Senior Vice President, Equities at Lauren Steinberg Wealth Management. Then, are Canadians still shopping local? Our featured guest, Pierre Cleroux, Chief Economist at BDC, says yes, and he has the data to back it up. And of course, we want to hear from you this morning on First Call. Give us your questions on global equities, and we'll have Martin answer as many of them as he can. The number to call will be 1-855-326-6266. We'll open the phone lines in about 30 minutes. And of course, our email is firstcall@bellmedia.ca. Now, here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Stellantis says it has surpassed 1,000 new hires for the upcoming third shift at its Windsor assembly plant. That's in southern Ontario, southwestern Ontario to be exact. The automaker also says nearly 240 of them are transferring from its Brampton factory after the company announced in October that it would move the manufacturing of a Jeep model to Illinois. Stellantis expects to hire up to 1,500 people for the additional shift in Windsor by the time it launches early next year. Montreal-based WSP Global has reached a deal to buy an American engineering firm from Warburg Pincus. WSP will pay $3.3 billion US in cash for TRC Companies, which sells engineering and consulting services to electrical utilities, energy firms, and other customers. The company says the transaction would position WSP as the largest engineering and design firm in the U.S. NASDAQ is looking for regulatory approval to extend trading hours on its stock venues to 23 hours during the work week. The firm asked the Securities and Exchange Commission for permission to add an additional trading session from 9 p.m. to 4 a.m. Eastern Time. This will be on top of the pre-market, regular, and post-market hours the firm already operates. NASDAQ is the second largest exchange in the U.S. And now our top line story. The Canadian government has approved Anglo American PLC's acquisition of Teck Resources, helping to clear the way for the creation of a $50 billion metals giant focused on copper mines in Chile and Peru. The companies agreed that 2/3 of senior executives will reside primarily in Canada, and the board will have 50% Canadian representation for 7 years. Let's bring in our guest co-host, Martin Cobb, Senior Vice President, Equities at Lauren Steinberg Wealth Management. Martin, thank you very much for joining us.
Good morning.
Is this about as good as it can get, do you think, for Canada on this deal? Then on what they're keeping the 4,000 jobs for now, same number in Canada will stay here. The headquarters will be in Vancouver, 50-50 on the board. Is this a win for Canada in this merger?
Yes, I believe so. I mean, they patched it together in a way that it would be, much more tolerable, digestible for Canadian politicians to accept the deal. Obviously, we've had the approval today. Well, we need to have the US approval. We need to have the Chile, the Peru approvals. So this is still a long way to go. But in terms from a Canadian context, they've obviously done their bit to try and make sure that the Canadian politicians, etc., would be happy in terms of keeping jobs here, having the headquarters of Vancouver, doing all that sort of thing.
Was this the biggest concern regulation-wise, or will there be any other possible issues in any other countries?
It really would be, what Peru and Chile say to some extent, because that's where the assets are, particularly in Chile to some extent. Think about the neighboring assets. Although I believe the way they put them together in terms of the synergy they can derive, it'd be a net positive for the Chilean government in terms of getting some of the issues, the production issues that Teck has had resolved with the help of Anglo. I believe that should be able to get past there as well. So they'll get there. It just takes a long time. It could be 2027 before this deal is actually consummated.
And then what happens? Is the focus, do you think, Chile for the new company?
Yeah, that's where some of the growth will be, Chile and Peru. If you look around the world, copper is tough. I mean, it's tough to find it in good quantities in jurisdictions that you want to deploy a lot of capital into. So really, South America, particularly Chile, but also Peru to some extent, is absolutely key in terms of assets with good reserves that you can actually drive production to some extent. So the combined entity would produce something like 1.2 million tons today. it would be seen to maybe grow to 1.3, 1.4 million tonnes over the next 3 years. Not great growth, but hopefully fairly assured growth. And most of that is coming from their assets in Chile, but also Peru to some extent. As I say, you look around the world, it's hard to find good quality copper assets. We know the demand picture, electrification, etc., is strong, but finding the assets and being able to produce the metal at a cost-effective rate is pretty tough, and that's why we like copper prices over the longer term.
And is this a bigger is better, or is it could it become too big?
It's not huge. I mean, it will be the fifth largest, combined company will be the fifth largest copper producer in the world, which is sizable. But it's not a massive company. You talk about a 50 billion deal. I mean, that's chump change these days when we talk about market caps, isn't it? If you talk about trillions. But in terms of the copper world or the mining world, and it's predominantly copper, about 70% of its assets would be copper. It's a reasonably sized entity that should be able to get some benefits of scale, etc. But it's not a world-beating company by any stretch of the imagination.
And going back to you mentioned about why that you're liking copper right now, is it AI that's driving that, or is it just general use and demand for it?
Well, there's AI. There's
the build out of the data centers and things like that.
Exactly. There's a lot of copper. I mean, I think I was reading that Meta's latest data center has enough cabling in it to go to the moon and back 8 times. There's a lot of copper into one of those data centers. You've obviously had, EV, although there's, signs that that's slowing to some extent. We're moving more to the hybrid model, but they still need a lot of copper. But it's not just the demand side, it's the supply side. If you look at lithium, for example, the huge demand for lithium for EVs and other types of batteries, but there's been such a huge supply response that the companies have struggled to make good money in that. The miners, copper is you have to look at the supply side, and copper is just that harder to get out of the ground. The reserves around the world, are getting more and more challenged, a bit like gold, etc. So the demand and the supply together, is more productive for a long-term positive view on copper.
Are we, not to sound fantastical, but are we in danger of running out of copper?
No.
Or at least mining, the ability to mine.
Yeah, there's plenty of it. I guess some parts of, if you go to some parts of Africa, the Democratic Republic of Congo, for example, I mean, the earth is red. The red metal is everywhere. Obviously, the difficulty there is the politics, not the geology. So you're looking for jurisdictions where you can have security on both the geology and the politics, and the ability to be able to bring that to the ground and sell it without the government stealing it. And that makes it harder to some extent. You put those two together, that's why Latin America, Chile and Peru have been pretty sensible in terms of their policy towards external parties involved in the resource sector.
But it sounds like copper could have a very interesting future, though, when you do have to look at some of those countries.
Yes, I mean, I think the long-term supply and demand dynamics for copper remain fairly supportive over the long term. Increased electrification, we talk about data centers, we talk about the power that needs to be produced in terms of electricity generation. You look at EVs themselves, et cetera, et cetera, et cetera. There's a very strong demand picture. So combine that with an ongoing challenged supply picture, gives you that lovely long-term outlook for copper as being fairly supportive.
Okay, we're going to take a break right now, Martin, but stick around. Up next, though, we're going to take a look at the markets before the bell. Let's see how things are shaping up on the markets quickly. We'll start with U.S. futures, AI and tech dragging markets down, along with the comm service and semiconductor heavy groups as well. You can see there. Off the Dow, it's almost a wash, but the NASDAQ taking another hit again, off by nearly 0.3%. Early trading, and S&P 500 as well. Taking a look at the Asian markets, it had a rough day all around over there. The AI tech jitters weighing heavy there. You can see Nikkei off by 1.56, Hang Seng almost the same, CSI 300 off by 1.2. Heading over to Europe, caution is the word ahead of the key U.S. inflation and job data that is expected today. Most of them are flat or down. You can see FTSE off by half, CAC 40 almost a wash, and the German DAX off by 0.34%. And the TSX finished the day off yesterday, again, second day in a row. Technology, energy shares pushing the market into the red. The investors digesting fresh Canadian inflation data, which was largely unchanged. So who were some of the winners and losers? Discovery Silver up by 4.6%, Empire 3.15%, Equinox Gold going the other way, down by 5%, and Perpetua Resources off by 6.85%. Taking a look at the metals, they're all hovering around record territory, but they're off slightly today. Gold by a quarter point, silver by almost 1%, and copper as well, which we were just talking about. All of them sitting near record territory, but copper's off by 0.86. And looking at oil, the downward pressure continues. Western Canadian Select off by 1.25 yesterday, and that's because of rising global inventory, softening demand, and that's putting that downward pressure. Take a look at WTI. It has dropped quite a bit in the last few days of trading. It was off by another it's off by another 1.78% right now. It had pushed up towards 60 last week, but now it's down around 55, 56. Well, NASDAQ has asked the U.S. Securities and Exchange Commission for permission to add an additional trading session from 9 p.m. to 4 a.m. to essentially extend trading hours on the stock to 23 hours a day during the work week. Bloomberg's Justina Lee reports.
The New York Stock Exchange has been planning a similar extension. I think one factor is, retail investors, they're already used to trading 24/7 on Robinhood and, on crypto exchanges. And another factor that, the NASDAQ statement pointed to is kind of global investors who kind of really want to be able to trade U.S. stocks, even outside of the regular trading hours, with more overlap with kind of a lot of overseas investors' working hours. And so I think these two factors are really kind of intersecting here for this push for, kind of close to 24-hour trading on work days.
So how would this look? I mean, it's not going to be a 23-hour cash trade. It would just extend, the after-hours session?
Yes, so the NASDAQ has gone to the SEC to ask for permission to add a session that's coming after, the after market hours. And, we kind of still need to untangle kind of a few operational issues, with the clearing and also with the data feeds and all that. And I think, the question here really is how much liquidity are we going to see in this kind of newly added session? Because if the liquidity is not that strong, it could be that we're kind of just going to get a lot of swings that won't really mean a lot to many investors.
All right, for more on this developing story, let's bring Martin Cobb back into it. He's the Senior Vice President, Equities at Lorne Steinberg Wealth Management. Martin, what do you think about the idea? I mean, I guess it's essentially kind of almost there, but it would be pretty much 23 hours a day. Do you like the idea?
Yeah, well, why stop at 23? Why not?
Let's go to 25.
and Saturdays and Sundays as well. So, a sign of progress, I would suggest not, but yeah, a sign of the times, I guess. As we heard, you can already trade stocks pretty much 24 hours a day on the likes of Robinhood. I remember the time when the UK stock market moved its trading hours from 9:30 in the morning, like we have here, to 8 o'clock in the morning. But that first hour and a half, really, I'm not sure what it's like today, but certainly for the first several years, there was so little liquidity that we just ignored it. It was like there was no benefit. And that's the kind of key question. Having worked for Templeton in Europe, trading US stocks, are they going to start trading in much thinner markets with probably greater bid offer spreads and less liquidity generally, or are they going to wait until the market opens to trade those US stocks? Because that the kind of key is, as we heard, liquidity will be all important. I suspect this is more just the gamification of stock trading that we've seen over the last decade or two, which is obviously exaggerated during the pandemic and might not make much difference. But for large institutional accounts, if liquidity does find itself outside of the normal trading hours here, there may be some increased trading, but I suspect most of them will stick to trading within the more liquid periods of when the US investors are actually awake.
Is this one of those things though, if you build it, they will come? Or
to some extent, I mean, who will come, Roger, I guess.
Yeah.
The retail investors will come. I think that will be great. So they're sitting on your Robinhood app in the UK or in Hong Kong, and you want to trade US stocks, you're less price sensitive. That will you'll probably see an increase there. So it's probably good for the likes of Robinhood and the retail brokers. I'm just not sure it's that important or necessary, for the large institutional accounts who are looking to trade with basis points of spreads and basis points of commissions and want to have the counterparty, other person on the other side of the trade, obviously large and liquid, is better than thin and not.
And what might be some of the benefits for people who are going to trade at 3 o'clock in the morning, other than they can only wear their bathrobe if they want? What are some of the benefits and what are some of the dangers for it, do you see?
Well, I think that, it's how you react to the noise. I mean, we have an environment, today where companies release news after the bell, after the trading is closed, to give people the time to digest. So the benefits and the dangers, I think, are the same thing. It's the ability to react to that. The benefit, arguably, would be me, a retail trader. I can, react very quickly to the news because the market's always open, effectively. But I think that's also the danger, is I'm reacting to the news without having time to fully understand it. So it will allow things to react more quickly, ultimately, to news. It will make that window where there's no trading, or where you can actually say something and give, investors the opportunity to digest, much shorter. I think that's a greater danger than anything. I read The Economist more than I read the newspapers, the morning newspapers. The reason being, they have a week to think about things before they make up the reasons for the stories. And, our brains love narratives. And if we're forcing ourselves to have, shorter term narratives, effectively, I don't think that's very healthy for long-term investing. But it's good if you're a trader. And
now, does this put pressure? I just saw a story that Hong Kong is looking at it. They haven't said yes or no, but they're looking at maybe going longer hours. Would this put pressure on the TSX or other markets?
I think it puts pressure on all of them, Roger. Absolutely. You're not going to be, the last exchange standing, with, 8 hours of trading if everyone else is offering 23 hours of trading. So ultimately, I think this is just a race to the bottom to some extent. It's a sign of the times rather than a sign of progress. As I said, we'll probably all be doing this at some point, and we'll be able to do our investing at the same time we're doing our sports betting and everything else on our apps all day, every day.
All right. Invest in coffee shares, right? Okay, Martin, we got to take a break, but we'll be back to see why gold is on your radar. That's coming up. Time now to see what's on the radar for Martin Cobb. He is the Senior Vice President, Equities at Lawrence Steinberg Wealth Management. And Martin, right now, as we head into the end of the year, you're liking gold still. It's had quite the run.
Yeah, it's very topical on investors' minds. I mean, who would think when we get to the end of the year and we look back and how strong gold has been and how strong stocks have been, it'll be up there in terms of, and probabilities in terms of just how normally gold does very well as a, as a risk, tail risk asset, as a hedge against, strength of equities who had the absolute opposite. So we're getting a lot of questions, not surprisingly, on, where goes the gold price, given that if you look within the TSX, for example, roughly 1/3 of the returns year to date, about 10 percentage points have come from just the gold stocks.
And is that worrisome, at least on a bigger picture for the TSX? That we're getting 10%?
It's certainly, is it worrisome? To some extent, definitely, because it's a speculative asset, largely. If you look at the gold, there's really two camps, with the gold. There's the Warren Buffett camp, where he talks about it being a big cube that sits inside the infield on a baseball, field, and earns you nothing, And then there's a more like in a James Grant camp, where they view it as an excellent diversifier, an excellent hedge against, debasements of currencies, inflation, and ultimately a store of value. And so there's a real debate. And if you look at this year in terms of being worrisome, what's driven the gold price? You hear a lot about central bank buying. They've been buying really at the margin. If you look at the increase in central bank reserves over the course of this year, it's largely because of the increase in the price of gold, much more than it is to do with the volumes, although there has been some buying, and obviously getting away from the US dollar, having your reserves in gold, which can be sanctioned, rather than in euros or US dollars, makes a lot of sense. But really, it's been investors buying here in the West, but actually in Asian markets, notably, have been big buyers of gold this year. So it's a speculative asset. And there are speculative drivers to the price. So that is worrisome to some extent. And now in the TSX, 1/8 of your entire investment, if you buy the TSX today, is in gold stocks.
And one of the other drivers you mentioned is also jewelry. I mean, I know we think about gold, but in India especially, it's considered an investment, but investment you wear.
Yes, exactly. So if you look at, we basically see about 5,000 tons of gold change hands every year. So roughly 3,500 tons are mined, and then 1,500 tons are recycled. Now that recycling does react to the price. The more And obviously, the higher the gold price, the more there is an incentive to recycle. And jewelry is a big chunk of demand, and it's fairly stable. And India and China are being certainly large markets for that to some extent. So they will be a kind of solid driver to ongoing demand. Given that just that jewelry is something you can wear, it looks quite nice, and is a store of value. But really, it's the investment demand that's been driving things, as I say, to some extent. That's the key factor going forward. And will investors continue to put gold away either physically or through ETFs? Now, we had that odd situation in August, if you remember, with fears over tariffs on gold. Mm-hmm. And so you had, basically airplanes leaving London, coming to New York with gold bars in them, as there was a lot of hoarding, and that's kind of washed through to some extent now. But it's the view of gold as being a store of value, prevention against debasement of currencies. We look at debt levels and spending levels around the world in terms of governments. Big question mark over fiat currencies. Gold obviously has its appeal in that environment.
And would it be a place people would move if they start rotating out of AI stocks and tech?
Well, you would have thought that it wouldn't have been a place they would have moved with the rotation in or the continuation of buying AI stocks. So I think the history books will be interesting to really understand the drivers of gold, which is, Moore, the investment manager based in Calgary, wrote a very good piece, I thought, on gold as being an excellent hedge of tail risk, when things go pear-shaped. Mm-hmm. It's not typically an asset that does pretty well when, equities are doing well, when risk assets are doing well. And that's been a year, 2025 has been that oddity where we've seen both of that. So I would say it's not badly positioned in terms of just being something you can touch, you can bite, you can store, or you can buy through an ETF. So it does provide that, alternative to something like the risk assets of AI stocks, etc. But there's a lot of other things I think would provide that attraction to other types of stocks in the market, not just gold stocks. So I think the setup is reasonably positive. If you look at the gold price today, 4,300, the average year today, it's more like 3,300. The gold stocks themselves will enjoy that nice tailwind of higher prices, roughly a third higher, even if the gold price does nothing over the next 12 months. So
you think there is stability to it for the next little while at least?
I think it's interesting. Calling anything on a next little while basis for short term is a mug's game. I've learned that over my 30-year career. But I think the setup on a long-term view, gold is an excellent addition to a predominantly equities-type portfolio. Having a proportion, 10% of your portfolio, say, in gold makes a lot of sense. That being said, if you buy the TSX today, you have roughly 12-13% of your portfolio exposed to gold stocks, which are a leverage bet on the gold price. So you have even more exposure to gold than you probably think. So be mindful of that.
Okay, we'll leave it there, Martin. Thank you as always. Up next, we're looking at whether the Buy Canadian trend is holding strong this holiday season with our next guest. And right after the break, of course, our phone lines will open soon for our first call. 1-855-326-6266. You can send us an email as well. First call at bellmedia.ca. Shares of Teck Resources are higher in the pre-market. British miner Anglo American has received approval from the Canadian government to acquire the Vancouver-based company. This clears the way for the creation of a $50 billion U.S. metals giant focused on copper mines in Chile and Peru. The company says they will seek inclusion in Canada's major stock indices and spend at least $4.5 billion in the country within 5 years. Stellantis says it has surpassed 1,000 new hires for the upcoming third shift at its Windsor assembly plant in Ontario. The automaker says another 240 people are transferring from its Brampton, Ontario factory after the company announced in October that it would be moving the manufacturing of the Jeep model to Illinois. Stellantis expects to hire up to 1,500 people for the additional shift in Windsor by the time it launches in early 2026. Kraft Heinz is replacing its chief executive officer on January 1st. Former Kellanova CEO Steve Cahillane will take over from Carlos Abrams Rivera. This comes after the food company announced in September that it would split into two entities. Callahan will become CEO of the company with brands such as Heinz Ketchup, other condiments, and boxed meals. The board will initiate a search for a CEO to lead the other company. And a little bit of a turnaround since we last looked for the U.S. futures in the green now. All of them up by about 0.1% right now, we'll say. Well, since the announcement of broad-ranging tariffs from the U.S., Canadians rallied to buy Canadian goods. Now that we're into the holiday season, is that trend continuing, or is it gaining steam, or is it tailing off? The BDC is reporting Canadians are spending more locally this holiday. Here to talk about it is Pierre Cleroux, Chief Economist at BDC. And Pierre, thank you very much for joining us.
Good morning.
You just had a report out a little while ago about what the planned spending is. What are the numbers looking like for Canadians when it comes to this holiday season?
Well, Canadians are going to spend an average of $943 for the holidays. This is about the same amount than last year. But what is really different is 46% are saying they're going to spend more on Canadian products and services. So this is important because this could really have an impact on the Canadian economy.
Martin, do you want to jump in?
Yeah, my question for you, Pierre, would be the very interesting report in terms of the movement is just the pressure on household budgets. We hear about it all the time. How much more expensive is it for a pressured household, during the holiday season to buy Canadian, and not go to maybe a cheaper global alternative?
Well, it depends what you buy. Canadians that are in the survey, they are saying that they are going to buy more, for example, on food and clothing that are made in Canada, on entertainment, for example, on services. So Canadians are making the right choice in terms of choosing, because like you said, budget is a bit tight this year. But what is very different is Canadians want to support the Canadian businesses, the local business, and that's the reason why they're shifting to more Canadian products and services.
And so, what does that mean for the economy if the 46% say they could end up buying an extra 50% of their goods were in Canada, and what would that contribute to the economy? How many jobs would that mean here that stay in Canada?
According to our economic model, it will have a positive impact on the GDP, will increase by $11 billion, and that represents about 45,000 jobs. So we encourage Canadians for this holiday season to spend more in Canadian goods, and we can even have a bigger impact than the one we have estimated.
And if you were to encourage Canadians to spend, would it be on goods or would it be more on services, the restaurants, something that's more local? Because I imagine the leakage on buying goods is more likely to have less of a multiplier effect if you were to spend money on gift cards for local businesses and restaurants, etc. Is that right?
You're right, and that's what we encourage Canadians. If you don't know what to give, a gift card is from a local business. It's a great way to give a gift, but also to give a gift that will have a positive impact on your community. Having said that, there's a lot of products that are made in Canada. Food is a good example. Clothing is a good example. Even personal care products that you can buy. Some of them are made in Canada. So good or services, the important part is to look at buying Canadian to encourage the Canadian economy. In this difficult period of time, we had trade tension this year. The economy has been slowing down. So anything we can do to support the Canadian economy, I think we should do it for the holidays.
Now, you mentioned about the made in Canada. I think one of the struggles people have had with trying to support this is what is actually made in Canada, what is something that kind of says it's made in Canada, but maybe isn't necessarily. And then we see some companies that are not Canadian, but then they make all their stuff in Canada.
You're right. There's a lot of different options. The good news is over the last 6-8 months, we see that it's a bit more clear. Often businesses will market themselves as Canadian business or Canadian product. They will have a logo as Canadian product. So it's a bit easier to make that choice today than I would say at the beginning of 2025.
And is there sorry, Martin, go ahead.
I was going to say on that point, I mean, I've heard the term, maple washing in terms of trying to be seen as being Canadian. Are you seeing evidence of a lot of companies and goods and services, do we pretend they're Canadian more, or is it just not really a big factor?
No, I don't think it's a big factor. What we see more is Canadian who make Canadian products that maybe they didn't announce themselves, market themselves as Canadian product. Now they do, because they understand that Canadians are looking for Canadian products. And it's not only products, also we're talking about services, entertainment, for example, and tourism. Canadians have been traveling more in Canada this year than less in the U.S. And we saw the difference in the number. The tourism industry has been really growing this year just because Canadians made that decision to travel more in Canada in 2025.
Okay, Pierre, thank you very much for joining us today. We appreciate it.
Thank you.
Pierre Cleroux is chief economist at the BDC. Still ahead, a new task force will launch in the new year to explore ways to protect the long-term health of Canada's softwood lumber industry. We'll hear from Natural Resources Minister Tim Hodgson. And, of course, our phone lines are open. Martin Cobb is taking your questions on global equities. Call us at 1-855-326-6266. You can also email us at bellmedia. First call at bellmedia.ca. I should give you that front part as well. First call at bellmedia.ca. We're back in a minute. A new task force will launch in the new year to explore ways to protect the long-term health of Canada's softwood lumber industry. The move comes as the sector faces steep U.S. tariffs. For more, we were joined by Natural Resources Minister Tim Hodgson.
Does the industry have the resolve to change? And can we provide with their help, think about how we provide the right incentives, the right opportunities for them to retool and respond to our new reality. So I think this is a different time. I just like to frame it for your listeners or viewers. I think the industry understands we are at a hinge moment. We are at a point where we need to respond to the new way the world works. We are in a much more mercantilist world. We're in a world where our largest trading partner has decided to charge for access to their market for all products. And that means an industry that has been geared for the last many, many decades to exporting large amounts of commodity product to that market is going to have to change. And I think that is something the industry has come to terms with. We now need to work constructively with the industry to find new sources of demand for Canadian wood. The great news is with things like our Buy Canada program and our Build Canada homes, we can create significant new demand for Canadian lumber products right here in Canada.
That's interesting, but in a way, the lumber industry is a microcosm of our economy, isn't it? It's just over the decades got used to just selling into America. It's going to be tough to change, isn't it? I mean, shipping lumber to Europe or Asia, I know we do a bit of that, but it's logistically challenging.
Actually, the biggest opportunity is right here in Canada. There is an opportunity for the industry to start producing much more engineered wood and much more mass timber products. Those products will allow us to build more affordable homes for Canadians. Those homes are going to use a lot more Canadian wood. Historically, our building codes would have allowed only a 2 or 3 story structure to be done in wood. With the new codes and using engineered lumber, we can now do 10, 12-story buildings all in wood. I was in a building this morning for the announcement that's entirely built out of engineered wood. When we do this, we can absorb huge amounts of our current production that is going as commodity lumber to the U.S. and use it right here in Canada. So it's a tremendous opportunity.
You're announcing a thing called the one window for forest companies trying to figure out this multiplicity of programs you put in. I mean, the government has put in well over $2 billion in various measures to support the forest sector. But that's a famous problem, isn't it, dealing with government? One minute you're dealing with an official, next minute they've gone on maternity leave or paternity leave, or they've been shuffled out of there. It's always going to be a problem, isn't it, dealing with the government and trying to get support programs?
Well, look, I prefer to see these things as opportunities rather than challenges. I think this prime minister comes from the private sector. He's used to key performance indicators. We are going to monitor how we perform against inquiries into the department. Our job is to be that one window. So when an industry participant calls in, our job is to understand the full spectrum of tools that we have in the toolbox and help that industry participant think about how it wants to re-engineer its business for this new reality. Again, we did not ask for this trade war, but we need to respond to it, and we need to win this trade war. And we will do that by rebuilding our industry so that it's stronger, more resilient, and more independent of the U.S. market.
We're tight for time, but it is a tricky one for you. The Globe and Mail reported a little while ago that the lumber companies came to you and said, would you ever advance us some cash that the Americans have been holding as duties? But you are reluctant to do it because the Americans might start claiming, oh, well, that's a new subsidy. So it's a tricky one for you, isn't it? Providing supports for the lumber industry. You don't want to add fuel or give them ammunition, I mean.
Yeah, so we need to be smart in how we support the industry. We need to do it in ways that doesn't handcuff the industry by putting additional unfair and unjust tariffs. I mean, I'll start from the premise that all of these tariffs are unfair and unjust. They're inconsistent with the existing trade agreement we have with the United States. But the reality is, they are there, and this is the world we find ourselves in. So we can complain about it, or we can be masters in our own house. And I think this prime minister and this government believes we can be masters in our own house, and we can use this crisis to come out of it stronger than we did going into it. That's what I'm working on.
And he was talking to Natural Resources Minister Tim Hodgson. Still ahead, notable analyst calls and recommendations in mining. Time to take a look at some of the notable analyst calls and recommendations. And we're going to start first with Scotiabank initiating coverage of Meridian Mining with a recommendation of sector outperform. The price target set to $2.50, implying a 67% increase from the last price. Morgan Stanley analyst Carlos de Alba cut the recommendation on Ivanhoe Mines to equal weight from overweight. That price target set to $15.20. It implies an 11% increase from last price. And Raymond James initiating coverage of Gatekeeper Systems with a recommendation of outperform. The price target set to $3 implies a 47% increase from the last price. Well, inflation held steady in November, climbing at the same rate as October, according to the latest Stats Canada data. But under the headline number, a very different story. CTV's Colton Prale reports on the good news and the affordability challenges still plaguing Canadians.
Today's data paints a pair of contrasting pictures. A national economy showing signs of improvement, but one where everyday Canadians are seeing their monthly and weekly bills climb even higher. At a headline 2.2% increase, inflation in November was on par with October. But core metrics closely monitored by the Bank of Canada dropped below 3% for the first time since March, a sign its fiscal policy is working. But ask Canadians how they feel about the economy, and it's a very different picture.
It's the prices that we're interacting with every day that show prices have increased way more than our wages. And so you have that sticker shock value when you're at the grocery store, when you get your cell phone bill every month.
Prices for fresh or frozen beef are up nearly 18% year over year. Coffee is almost 28% more expensive. And this month, higher prices for fresh fruit, berries, sugars, and confectionery mean grocery prices are 4.7% higher year over year, the biggest jump in 2 years. Canadians are also paying more for their cell service, which climbed nearly 13% this year. According to Thiessen, part of the reason Canadians are feeling the impacts of inflation more is that in the last 4 years, food prices have climbed roughly 30%, while wages have jumped only 20%.
And that was CTV's Colton Preo. When we come back, Martin Cobb takes your questions on First Call. All right, time now for First Call, and today it's first email. It's from Fred and your view on Whitecap, ticker WCP. Martin, I'll let you take it away from here.
Kind of interesting. Much different entity than it was 6 months ago. They had the combination with Verwin, which made them basically roughly twice the size. When I look at any commodities producers, particularly oil and gas, the first thing I look at is the balance sheet and how much debt do they have. They carry a little bit of debt, but roughly about 1 times EBITDA, so it's not too bad, but I'd like it to be a little bit lower. And the second thing I look at is how their free cash flow, particularly over the period of 2020 when oil prices were very weak. I know there's a different entity today. Whitecap themselves were free cash flow positive during that period as they ratchet down capex. So it kind of ticks both of those boxes. Obviously, there's an oil price component to this. I spent several years as an energy analyst trying to predict oil price and realizing it was pretty futile. The IEA, whose forecasting ability is no better than mine, have come out saying there's a bit of a glut next year, and they're worried about that. But you got to look longer term, and ultimately, with a long-term constructive oil price above the marginal cost, Whitecap doesn't look badly positioned. A reasonably low-cost producer of light oil predominantly. So yeah, not a bad place to be in the oil and gas space.
Okay, let's move on to an email from Shane, and it says, I actually read this email, Martin, like I could be sending this email. Diageo, I like to drink it, but should I buy it?
Yes and yes. We own Diageo, have done for several years. How long could I talk about this one? I've actually covered Diageo and its various predecessors over the past 20 years. There was even a time, and I went on it, when there was enough listed Scotch whisky producers that you could do an investment tour around the Highlands of Scotland, and I went. That doesn't exist anymore, sadly.
But keep going. I'm interested in that part, though.
Yeah, no, it was me, and I was the youngest there by a generation, and so I just remember, there was Highland distillers, etc. You go and you taste the product. I don't know why. Did I learn anything? No, but I had a very good time. So Diageo is a combination of various entities that come together, and it's one of the world's leading Scotch whisky producers. Johnny Walker. They have Smirnoff vodka. They have Tanqueray gin. They have Baileys, and they have Guinness beer. So it's got a great portfolio of long-standing brands, and the average liquor brand has been around for 100 years. These brands don't come and go. Great pandemic, because we all sat around and did nothing else but maybe consume a bit too much alcohol. And there's been a real hangover from that in terms of just, you saw 40% growth in Latin America. It's now negative. So we're in a period where there's been a real, kind of peeling off in demand, and it's been slightly negative. And now everyone's extrapolating, saying the young don't drink anymore. And the long-term outlook is negative. And I think that narrative is just too simplistic. Kind of felt we've heard this before. Outside the West, the young are still drinking. And maybe there's a pandemic effect, of the teenagers being stuck at home, not getting into that kind of party, mindset and not drinking so much. But long-term, I view the outlook for Diageo, its portfolio of brands, as being excellent, and it's trading on dirt cheap valuation.
Oh, interesting. So going back, I just want to go back to the youth for a second. I know, because I know here a lot of kids, my son is 18, and none of his friends really have a drink at all. But outside of North America?
Yeah, we're seeing it. I mean, there's debate, and RBC's, their consumer staples analyst, was kind of pointing to this as there was that terrible period where everyone was just shut at home, and you're finding that the youth in the West, in this part of the world, they're not socialising, they're not drinking, they're not even going out. And the terrible statistic that your average inmate in the US spends more time outdoors than your average 20-year-old boy. It's not a good thing, but sadly it's partly what we see, and that'll probably flow through over time, and maybe the younger generation will drink more to some extent, but the older generation are drinking more. And then you go outside, 96% of the world's population is not in America. Obviously they spend more. You look at areas like India, other parts of Asia Pacific, Latin America, Africa, where you've got huge and growing populations are drinking more. And Diageo's kind of strategy is premiumization, upselling your Johnny Walker labels, black, green, blue, etc., and then a volume story. So there are short-term pressures. Ultimately, I believe they'll prove temporary. The world has not changed all that much, in my view, and the company is very well positioned to benefit.
Okay. All right. We'll leave that at 9 o'clock in the morning. We're taking a break here. Do we have time for that one? No, we ran out of time for that one email. But that occupied nothing like a 9 o'clock morning about scotch. What was your favorite scotch from when you went on that tour? Before we go,
my favorite's Talisker, Isle of Skye. It's not too peaty, but it's got enough peatiness, just to keep you going. So it's one of my favorites. But take your pick. And I must admit, even some of the Japanese whiskies are also very good. I shouldn't really say that as a Scotsman, but there's plenty of good whiskies.
That's heresy, isn't it?
I know. didn't say that.
Okay.
On live TV.
We didn't hear it, Martin. Thank you very much for joining us today.
Thank you.
That's it for us here on The Street. Thank you to Martin Cobb, Senior Vice President, Equities at Lawrence Steinberg Wealth Management, for joining us. Andy's up next with the Open, and the market's open in just over 30 minutes from now. Have a great day.